And yeah, markets today, interesting things that's happening. A lot of, so you can see we're sort of on a swivel point when it comes to the economy. Not from bad to good, but actually the other way around. So there's obviously been a lot of earnings that's been released today. And obviously Microsoft, which was their first miss in quite a while. Meta, Qualcomm, British American Tobacco, Ford, Shopify, Deutsche Bank, Boeing, lots of misses. But I don't really like to focus too much on earnings. Earnings sort of is just it's almost like the GDP. It's a little bit of a tailing indicator. It doesn't really tell us what's going to happen in the future. It can sort of confirm momentum. So it can confirm if you have a suspicion that stuff is going to go bad and there's bad earnings, you sort of have a confirmation that yes, you might be on the right path. But in general, it does happen after the fact. So it's not really the way you want to do it. So yeah, the fact that there have been so many misses on estimations is sort of an indication that yes, there's some bad news ahead. But then there's been a lot of releases, or they call it prints, that's is more of what's actually happening now, and a bit of, I don't know if there's actually been much that can tell you what's going to come. But we had the 30-year MBA rate, that's the mortgage rate, and the mortgage rate it's actually an interesting one. It's down from 5.8 to 5.7. I actually expected to be up, so that was a bit of a surprise to me. Obviously with the interest rate hikes we would expect it to be up, but I think the reason maybe it's down is because the actual home price sale, or the actual amount of houses being sold, is less. So that actually brings you to the second print, and that was the mortgage applications. That dropped quite a lot. It didn't drop a lot, it dropped a little bit less. So the previous month it was a 6.3% drop. This month only a 1.8% drop. So it's still dropping, but yeah, that obviously is why the mortgage rate isn't as bad as as I expected. Then there was actually a really good one that came in, and that's the durable goods orders. That was actually a beat. I think the estimates, I don't know if the estimates, this is a beat by 0.2%, and from 0.2 to 0.3, that was the durable goods orders, and that's actually a good thing. That means that there is actually a bit of a demand for durable goods. But it's also a little bit interesting, because if you look at some of the other figures, I don't know if it's really significant, because the next print was the retail inventories, and that's up by 1.6%, as well as the wholesale inventories up by 1.9%. And usually, if this goes up by more than the estimated amount, usually that's a bad thing. But I think in this case it might actually be a good thing, because that will help with inflation. If there is excess stock in inventories, it's definitely going to help keep inflation under control, because the retailers are gonna, and the retailers and the wholesalers, they're gonna want to get rid of their inventory, so they might drop their prices. Obviously, it's not going to take away the pain, it's just spreading the pain. So instead of the consumer going through the pain, the retail and the wholesale sort of shares some of that pain. But in all, it might help with inflation. So that's sort of a good thing, even though in normal sort of economics it's a bad thing. I think it's just basically where we are right now. That's a good thing. Pending home sales, that was a big miss. That was down to minus 8.6%. That's a massive drop. But that sort of obviously goes from the previous month, which was minus the mortgage applications, which obviously minus 6.3%. It's sort of that realizing now into this month that's why we've got that massive drop. But the weird thing was that the estimate was minus 1.5%. So yeah, there was a big miss to minus 8.6. And yeah, that's also been sort of steadily dropping over the course of the last couple of months. Obviously, there was also a lot of crude oil inventories, just like basically breakdown. Nothing really that I saw that stood out. I mean, we know that Biden did say that there's going to be a lot of inventory oil released purely to sort of help with the oil price, and we can see that we basically used about half the inventory that is available. So we can't really sustain the oil price as it is now for much longer. We sort of have another month, a month and a half left, then we're out of oil. Then the price is going to have to go up. So yeah, we just hope that someone will help. Biden somehow fixes it. I don't actually see a way. The problem is that America wants all the eastern countries or the Middle Eastern countries to produce more oil, but in order to do that, they need to obviously go through some costs themselves in order to produce this more oil. But what happens if the problem goes away? So basically oil prices come down. The America will be like, okay, cool, yes, thank you for helping us with the oil. We no longer need as much oil, so we're going to buy less oil from you. And then basically the Middle Eastern companies have gone through all this cost of deploying more oil, but it will only be for a month or two, so they're not actually going to get their money back. They're actually going to be in a deficit, and that's going to be a massive issue. Two people, they bumped into each other. Well, that created a bit of a gap for me at least. So that can be a bit of a problem. I don't know how many of the Middle Eastern countries will actually agree to just pump more oil, because they're kind of all at their limit. In order to go above their limit, they need to spend more money. And how do you justify spending more money if it's only going to solve the problem for a couple of months? It will be worth it for them to spend more money if it was obviously over a couple of years. Then they would slowly over time get a return on their investment. The next thing we have to actually start looking at is the trade balance. The trade balance is basically your difference between your imports and your exports. So America has always been they've always imported more sort of value than what they export. It's never really been a problem, because if you have the reserve currency, you just basically print more currency and that way you just solve the problem. So you basically print your way to wealth. And now what's happened in the last couple of months is the trade balance has gone down, which basically means that there's a lot more export than there's imports. So that balance is not actually good anymore. The reason why it's an issue now is because obviously we can't print as much money anymore. Printing of money is like a sin. So yeah, Jerome Powell he's calming down a lot. He's essentially stopped the money printer. But now, because of that, this matters. So it's around about 100 billion a month, which is a lot. That's just to give you an idea how much money that was printed in Corona in the peak of stimulus. It's that much. But okay, not exactly that much, but almost as much. I mean, I think at the peak we're printing 120 billion a month. We're now at a deficit with our trade balance of about 100 billion. It has gone down. Which is a good thing. We were sitting at 104. Now we at 98 million. So 98 billion. So that's a good thing. Because that needs to come down by a lot. There's a lot more spending than there is actually exporting. So that's a big problem. And the other problem is the job cuts. So it sort of links in with the job cuts. So obviously when there's job cuts, there's major companies that announced job cuts. Microsoft, Meta, Tesla, they all announced big job cuts. There's also lots of big companies on the S&P 500 that has said that they will suspend hiring or limit hiring a lot, and that's your Apple, your Google, Amazon. They've all limited their hiring, which means that jobs are going to become an issue. So, and if there's less jobs, there's less production, which means there's less exports, which means your trade balance is an issue. You can't print more money to fix it because of inflation. There's to fix inflation, the Fed needs to raise interest rates, but you can't raise interest rates if there's major job losses. So the Fed's sort of working its way into a corner where it's gonna almost be like a checkmate scenario, where it doesn't matter which way they turn, there's going to be severe consequences. So it's just what's on the horizon, what I'm seeing that's happening. Let's hope it doesn't play out, because the trade balance can really it could really hurt, if especially now there's no more money printing, and this money is essentially leaving America. It's getting poorer. But later today we're getting the FOMC statement and the press conference, which I'm really looking forward to. That's in, I think, 2.5 hours. Yes, 2.5 hours. And then obviously the interest rate decision, which I'm hoping is your 75 basis points. Hoping it's more, but I don't know if it's safe to really go more. I think 75 basis points is actually a good decision. I know there's a lot of people that just want the pain. They just like, let's throw it, let's hike interest rates, let's go through the pain, rip the band-aid off. But the problem that will have with job losses and how that will hurt the economy might be worse. So we do need to go through a very gradual recession. We are going to go through a recession. There's not really a way to go around that. There's going to be a recession. It's the Fed's job to make it a very gentle recession. So we need to sort of see if we can just gently ease into this recession, so there's not too much sharp pain. But that's basically the market update for today. If you like this video, then remember to press the button. If you want to see more, then remember to subscribe. This is Steve. Until next time, ciao.